Okay, it's Michael Connor, Cheat Sheets. Today we're going to review our relative strength rank and trend report. And boy, do we have a massive ton of data for you. We analyzed over 110 different industry group subsector ETFs. And I think rather than going over how to interpret these cheat sheets first, I think the best thing is to dive right in, and then we'll go back and summarizing the rules. Sometimes the best way to learn is to visualize. And for those of you who are cheat sheet vets, don't worry, this is all new data, not sample out-of-date data. And we should be able to give you a lot of insight as we go. So those of you new to cheat sheets can learn, cheat sheet vets, you can learn about what's going on right now. The first thing to pay attention to is the general, any place on screen you see a general transition between red and green. Red corresponds with low numbers or ranks, and green corresponds with, high numbers and low ranks, and green corresponds with low numbers, but positive ranks. So low numbers are better, and red high numbers, meaning high digit count numbers, are worse. What we're looking at is not unlike the standings in a sports league over time. Teams can go on winning streaks, losing streaks. Sometimes they play 500 football or baseball or European football or soccer, as it's called. And some teams are dominant and others are pretty weak. And that can change over the course of a season. But generally speaking, the more time that passes and the more strength on a relative basis your team exudes, usually by racking up wins, the better you tend to do in the regular season. And that, of course, influences better positioning in the playoffs. Well, that's what we're doing with these 110 plus different industry group and sector and index ETFs. That is, we're measuring their strength over time. The most important time frame for we intermediate trend followers is, roughly speaking, 60 to 120 trading days, which once you factor in weekends is roughly 3 to 6 calendar months. And what we're looking to do is capture changes in relative price performance. And that's what these numbers mean. It means that, for example, and I'm just going to use the Uranium junior miners here. I'm going to use the extreme left-hand column that's marked after the actual ticker symbol and the description. We have a average relative strength rank over the past 3 to 6 months, or 60 to 120 days, trading days. We see 56. So out of roughly 110, it's actually more like 112 different industry group ETFs. The junior miners for uranium show up at about middle of the pack in that most important time frame. Now, the other thing to notice is that the junior uranium miners, along with copper just underneath it and an ETF that just captures the spot price of uranium metal itself, and another uranium miner ETF that we just use as a spot check to make sure that thinly traded ETFs aren't exuding bad metrics. You'll notice that there's a general trend, although it's slightly different for the metal compared to the miners and for copper specifically, that there's a general rotation from lower price performance, that is the changes in price to the upside compared to the other ETFs here. There's a general transition from low rank to high rank. That's what we call rotating into favor. And we definitely want to see it in the sweet spot. And we start to take it seriously once that rotation transition starts to impact about 60 days. So whereas the first stock ticker, first row, uranium junior miners, you can see that the relative strength rotation gets serious by about day 40. That's where we transition from 54th place to 19th place. So the difference in price performance 40 days ago to today is that this, of all the 110-ish ETFs that we've measured, this is the 19th best ranked in terms of delta in price improvement, where the rate of change has moved from 54 to 19. Positive relative strength, but not yet in the critical sweet spot. Off to a good start, but we don't place as much value on it until we start to see it rank in about the top 50% within that more important time frame. So that's relative strength. And if I were to go back in the deck, which I'm still getting used to, by the way, I apologize. Maybe I go this way. Come on. Maybe I go this way. Yeah, okay. So as we look at this, this again tells you that you compare the ETF's average relative strength on the far left to the trend in the sweet spot on the far right. And the two highlighted examples, one shows early rotation, 28, 25, 15, 12, and then into single digits. So the rotation starts in the sweet spot and picks up speed right as we transition out around the 60-day mark. And then there's another one, it would be the bottom ticker, the one that transitions from 35th to 26 to eventually 2 on the right side of the sweet spot. That is bullish rotation. So that is a very important factor in understanding where the puck is likely to be, because generally changes in relative price performance happen before absolute price performance. So remember, we've been going down in a lot of markets now. Sometimes this means going down less, which brings us to our second collection of metrics. That's trend. And you'll see here that there are 3 different columns where trend is measured. We have the shortest time frame on the left, 5-day moving average, exponential moving average over the 20-day moving average. When the short-term time frame is bullish, the shorter period moving average will be above the longer time frame moving average. So in this case, by short term, we mean 5-day over 20-day exponential moving average. The intermediate time frame, that uses the daily charts, 40-day exponential moving average, we would be bullish on the trend if the 10-day moving average was greater than the 40-day moving average or above it. And then we have the weekly moving averages, the slowest moving time frame. But once again, we're bullish in the long term or the longer term, or our in terms of a trend following system that we follow, it's forever, the 10-week moving average over the 40-week moving average. So when you have trend up and relative strength also moving in a positive direction, then you're generally in a bullish trend already. As you can see, while uranium and metals and miners are showing a little bit of early relative strength, it hasn't affected the trends we care about. So this would be an example of how we're anticipating what could be to come. And it's why we've got at least the uranium juniors and then the uranium miners, both with watch closely grade designations. More on that in a minute. All right, then the final place is money flow. And money flow is a measure of buying pressure. So buying pressure is the characteristic that we care about. Chaikin money flow is the underlying metric through which we measure that buying pressure. Institutions are the group that control the money in the market. They have billions under management. I'm talking about financial advisors, family offices, hedge funds, pension funds, insurance companies, big investment banks. They put tens of millions, if not billions, to work. And generally, they'll dollar cost average into a position over a period of time to avoid having their large purchases move markets too much. And that's where we get the notion that the big money whales are something in the meat needs your attention. Go to the meat tab. Okay, I know what this is. They're saying, are you still there? Stay in the call. Yes, we're still here. Please don't cut our recording off like you've done the 10 times beforehand. I definitely need to find a different way to go about doing this. So I think the money flow is best explained by me going to a chart. And it doesn't look like I'm able to move the slides until I actually go to the meat chart here. And so let me do that and just show you our definition of money flow here. Here we go, view tab and meet.google.com. Okay. But can I advance the slides? I cannot. Oh, what a terrible system this is. I wish they would make it better. Okay. So Chaikin money flow again. Institutions are acquiring stock when we're very bullish, above 0.2. When we're very bearish, institutions are dumping stock, or sometimes we'll call this puking stock, below negative 0.2. And anything in between is different permutation of money flow. The higher the number, the more bullish. The lower the number, the more bearish. All right, I'm going to go back to the document and see if we can't advance the slide. This is so irritating. All right, I think I'm advancing the slide now. So now with money flow, trend, and relative strength trend, relative price performance, we can put together a grading system in a way that makes sense for you. So grade A is the toughest bar to hit. Grade A means that we're seeing both accelerating buying pressure and accelerating price movement because the trends have to be there too. So money flow must be very bullish. That's above 0.2. Both the long-term, the weekly and the daily exponential moving averages have to be in an up position. They're trending. The average relative strength rank across that sweet spot area, the 60 to 120-day look-back period, we need that rank to be in the top 50% of all ETFs measured. So the bigger the stack, and we've got a doozy of a one today where we're looking at 112 different industry group ETFs, you have to be in the top 60 in order to even have a chance at grade A, and that's in the sweet spot. And then in that earlier time period to the right of the sweet spot, the 10 to 50-day look-back period, roughly speaking, up to a couple of months, right? When you add in the weekends, or maybe just slightly less than 3 months, we have to be in the top third rank. So out of 112 ETFs, roughly speaking, we need to be in like the top 36, top 34, I think exactly the top 34 ETFs. So a very high bar, generally speaking. The stock or ETF is already trending and is under bullish or very bullish accumulation. A grade B is just a little bit earlier in the life cycle. So again, the earlier we are, the more potential we are to failure, the more reward as a result, because the more room the stock has or ETF has in front of it. So the parameters are just slightly more lax. Money flow is at 0.1 instead of 0.2. Either the long-term weekly trend or the intermediate trend, that's the daily moving average pair, are up. We don't need both. Think of it this way. When a stock is first starting out after being bearish, the long-term moving averages are probably more likely to be in a bearish position. The earlier movers are going to be the 5 over 20 and eventually the 10 over 40-day exponential moving averages. So it's not uncommon for us to see long-term trend down, intermediate trend up as we're rotating into favor and beginning a nice bull run, okay? And that's why we do an either or. Same can be true too when the intermediate trend of the stock gets interrupted during an extended consolidation, for example. When the weekly trend is intact and money flow still looks good, we'll allow for a moving average pullback while the stock resets and consolidates, because likely there's another big intermediate run ahead as long as those other metrics stay firm. And so that's sort of how we use B. We need that near-term relative strength to outrank the sweet spot relative strength, because we need to see that relative strength is continuing to improve and that we're not just looking at a stock that's already seen its best days for this cycle and is fading. And then the average intermediate term relative strength, that 60 to 120-day sweet spot period, still has to make it into the top 50%. So looser, but still pretty high standards, rewarding stocks earlier in their cycle. And then watch closely our most risky of the three grades. Well, I guess the most risky is ones that get no grade at all. They're either fading or they're just dead money. But in terms of the ones that are in play, I'll watch closely grade. Shaken money flow just has to be a positive above zero. Does not have to be under heavy institutional accumulation. The average near-term relative strength rank, that is the shortest term, the 10 to 50-day period, we just want it in the top half. We need recent relative strength. And then near-term relative strength rank, the average has to be better than the sweet spot rank. So these are early days, and with early days comes fake outs. So more risk, but more potential reward. And those are our three major grades. And this is an actual, this is the first 30 or so index ETFs. So the other themes we're seeing is kind of in the next sliver. We know that silver miners had been underperforming gold, but in a quiet bull trend themselves, up about 25% over the last few months. And we can see here that metals and mining, which is sort of a catch-all for both industrial metals and for gold and silver, that one is actually rotating into favor right through the sweet spot. Trends aren't there yet, but we're watching closely because money flow is just a tick south of bullish, and we would, we're probably going to get money flow up above 0.1, and we'll be waiting for the trends. So it looks like metals and mining have a pretty good future ahead, and we're going to watch that area closely. I didn't spend time talking about ESPO. That's a persistently strong stock or ETF. We do a deep dive in the article, though, but that's definitely a grade A stock meeting all of our criteria. And then the next kind of place I see potential new bullish action is going to be down here at the Spear Alpha ETF and FXL, the First Trust Technology Alpha. I believe these are ones that use some kind of built-in put protection. So they're using some financial engineering so you can be in the Mag 7 in a more risk-controlled fashion. We are seeing a little bit of relative strength. We're not seeing any trend action. We may be seeing on FXL, for example, or more likely SNSR, the Global Internet of Things. While the relative strength isn't there, boy, the money flow sure is. Now, we do a deep dive into SNSR in the article. So I'm not going to get into the fundamental theming. Here's ESPO, by the way. The one thing I wanted to share with you about ESPO, which is a persistently strong ETF, we share why that's the case in the article. But here's an example of our quick view charts with a little bit of a tweak. And it's something that we're glad to provide our annual paid subscribers. So if you're taking advantage or plan to take advantage of the $50 a year plan, it's less than the $5 a month a la carte plan. This is for paid subscribers. We'll give you the ThinkScript code for this indicator, along with a couple of other versions of this indicator. What I wanted to share with you today was that when we're in a market that's really volatile, like the one we're in, where there's going to be extreme movement to the up or downside, our 40-day moving average, which is our standard indicator, is not as helpful to us, because while we do want to allow stocks a little bit of wiggle room, too much wiggle room, and you could end up losing a lot of money when volatility is high. So we tighten up our moving average, and as a result, our volatility-based stop loss, which is set in this case to a 1.5 times the average true range over the last 5 days. And we're using a 5 trading day moving average, exponential moving average here. So that's really tight. The idea here is to ride up the green. We know that green is bullish for a variety of reasons that we explained in our previous video, which I recorded and distributed on Friday night. And actually, I think we just inadvertently went across charts. So this is the 5-period moving average. And you can see we'd be getting in roughly here based on our trading rules, close above the high of the low or pullback day. Maybe we're getting in here if you really want to find the bottom. And we're riding this trend until we finish below not only the 5-day moving average, but then we actually run into the stop loss here about $2 or $3 below the moving average. So this would be an in here and an out here. Locked in profits already. This thing might keep running. So when we're in a bearish market, we tighten up the time frame, and it's more about riding the swings of the market and a little bit less about riding the trend. Why? Because the trend has been down. And so we only do the wider moving average stops when we're seeing higher highs and higher lows in the market, and we're not seeing that right now. All right, moving on to another. This is just another version of ESPO. This is the 21-day version. We're still using the same inputs that drive the background and foreground color change. By the way, for those of you who are familiar with our market sentiment, long-range market forecast oscillator, notice that the red background and the green background aren't helping us at all. This, again, has to do with the type of market we're in, where this is extrapolating and looking for performance that has the potential to last months or even a year or more. In a market that's oscillating with fast ups and downs, this oscillator is too slow to be useful. And you'll notice that we're fully red during a period where we usually catch the big uptrend when we're in a normal bullish market. So I just wanted to point that out, that these types of background long-term sentiment indicators are less useful. But what could be more useful are these variable moving averages, and we provide 3. We have the 5-day moving average, the 21-day moving average, and the 40. 200-day moving average. All exponential, all that are turned green on increases of money flow and the intermediate market forecast oscillator, all explained in depth. What I'm going to do here is just view the tab here to make sure that we are still recording. And it looks like we're still recording and all systems are go. So we'll go back to the tab and make sure that everything's running. And let's move on to the next one because there's something else I wanted to share with you that I think we've got here. Okay, XME. Again, we're using that 5-period moving average. Now, XME, we showed you, was beginning to rotate into favor from a relative strength standpoint. And yes, in this case, the long-term market sentiment rating has turned mildly bullish. You'll notice, though, that the foreground moving average has not turned correspondingly green, which means that either money flow and or trend is not with us. And so remember, we refer back to our rules, which are going to be back here. Sorry for the head whipsaw, but I think this is important. Remember that in order, the rules for money flow are on Friday's video. A little Alzheimer's moment, sorry. Yeah, I don't have those here. Okay. And so XME rotating into favor, but still not in a bullish trend. That's my point. And if we go back and look at XME down here, God, I gotta get better at this, don't I? XME is here, rotating into favor, but trends not there. And remember, we need at least one or the other to get a graded rating, and that explains why our quick view charts are so anemic. Okay, so this is the second tier of the industry group ETFs here. So we're now dealing with the 28th through 50th highest ranked of the 110 industry group ETFs. And this is a chance where maybe we get back in our chopper and fly above the individual tickers. And I'll tell you how I like to approach dealing with dozens and dozens of ETFs, because we certainly don't want to spend any time looking all of them up. The only ones we should care about are the ones that scream at us. So start with Chaikin Money Flow. If you don't see a green rating or a watch closely, it's probably not that important for you to deal with this week. So just eyeballing, I see one green, one watch closely, another watch closely, another green, another green. And we would then, so we've now taken, what's 25 ETFs and gotten it down to maybe 6 things that we have to consider. And we can very quickly see there's no positive relative strength rank rotation and no intermediate trend. We do have a barely bullish Chaikin Money Flow. So IGM, which is one, again, expanded tech sector, we might want to go and understand what that means, but not get too concerned about about it. It's definitely not a trade prospect, nor would the underlying stock holdings in that ETF. Continuing down and looking at money flow, this one does look interesting. This is PHO. It's Invesco's Water Resources ETF. We definitely see a relative strength move that's through the sweet spot, a little bit of weakness last week. Still don't have the trends along for the ride, but we've got money flow above 0.1. So with a full-on sweet spot, relative strength rank rotation, we'll have to forgive this past week where it fell to 46 for the last 2 weeks. And a positive money flow. This one's definitely, even though it has no grade, it's one that's worth watching closely. I definitely put it on my watch list. Whereas the other one, which is Invesco Dorsey Wright Technology Momentum Fund, boy, is momentum dead right now. There is no relative strength, no trend in any time frame. Yes, there's probably some big value investor that likes something here, but for us trend followers, not enough data to warrant a closer look, not yet. And that's how we can blow through large swaths of the market. I'm now on to 52 to 73, and I'm only going to do this a little bit more. You can see that there's no relative strength here for cloud computing, despite a decent Chaikin Money Flow. Chaikin Money Flow or relative strength appears to have failed on the pharmaceuticals, and that could have to be something to do with the Robert Kennedy policy announcements out of DC. There's no trend. And yes, there is some money flow, which we respect but don't deal with. This one, Invesco Aerospace and Defense. We covered this, a different version of this, XAR, on Friday. We're very bullish and think the data is there right now. You can see the sweet spot rank is persistently, with the exception of this past week, where clearly there was some type of pull down that's affected the relative strength rank. It's still pretty green across a big swath of time. up in multiple time frames. And listen, we're only 0.4 of a point, 4/100ths of a point away from a bullish money flow reading. This one to us looks like a potential pullback and a buy the dip opportunity. We'd transition from this particular set of forward-looking metrics back to our reliable tailwind score and some of our trading signals and see a good entry point for aerospace. All right, we'll do one more slide here. I do see something called Fidelity's MSI Materials Index. Again, hard assets seems to be a recurring theme. No real relative strength here. I think you'll find in our cheat sheets article, we talk about the need for industrial metals because not only do we need to build the factories, but the factories themselves are going to need to build stuff. And there'll probably be a lot of AI automation rather than human workers assembling stuff in modern factories. So FMAT catches our interest from a fundamental standpoint. You can read more about the convergence of those particular materials and science-based ETFs that seem to be doing well. But we definitely pay attention to this FOMO level of 0.43 money flow, despite the fact that no trends are here and no relative price performance to speak of, though we are in the top 50%. It's not horrible. But this is one definitely to watch closely. These materials ETFs are going to matter someday. And that, I think, gives you the idea of what's going on and how our relative strength rank and trend report goes. In our user guide, we get into the specific meanings of the quick view charts. Those were the green background and then the variable colored exponential moving averages that we shared with you. We have explanations for the months part of the equation and then bullish scenarios that combine the 40-day exponential moving average in the foreground with its variable color scheme with the background colors. And so we explain that in user guide. We show you, and we did this the other night, where the Qs and the other major indexes are. And so I think you have all the tools necessary to start the trading week. If you're not yet subscribed to Stock Cheat Sheets at Substack, go there right now and give us a subscribe. Most of our articles are free, but the content for paid subscribers is extremely valuable. We take and give you the big picture in our free section. So, for example, aerospace, as we did this past weekend, with our premium subscribers at $5 a month or $50 for a year, you're getting the top tailwind scores of single company stocks within the aerospace ETF and a deep explanation. We do a ton of research about the fundamental factors that drive particular subsets within aerospace, because it's not all one big pile of different weapons manufacturers. There's a lot to each of these specific industry groups that we're analyzing. So stockscheatsheets.substack.com is where that's at. That's where to subscribe. If you're watching me on YouTube, the like button helps us get the word out. Think of it like giving us a tip. Yes, we're helping convince the algorithm to serve our video version of cheat sheets to more people like you. So the way you'd leave a 15 to 30% tip, outrageous, at Starbucks, if you can just hit the thumbs up, that's the equivalent of giving me a small tip for my time, and it would be greatly appreciated. And anyone subscribing, you can't know how validating it is to know that I'm worth, that my mind and what I've shared with you is valuable enough for you to part with a small amount of cash. It just is very self-validating, and it motivates me to do the work for you and help you use this data to navigate through the toughest markets we probably have ever been through. I've been doing this since the late 90s, and I can tell you for a fact, there is nothing more treacherous than the markets that are presenting themselves today. So that's it for now. Happy reading, and we'll talk to you again soon as I figure out how to shut this off. Thanks. Have a good day and night.